This is Tim Phillips, Chief Investment Officer at Phillips and Company Advisors, and I'd like to thank you for taking the time to review our Q3 2023 look ahead. Please read all the disclosures carefully. We've all been collectively waiting for the first shoe to drop on the U.S. consumer, and it simply hasn't materialized. Job growth is still robust with only a modest drop in wage growth. The consumer is still sitting on large balances of excess savings and about $700 billion in debt service capacity. Consumer confidence creeped up just a bit, but still well below the highs. So the so-called recession coming is still pretty hard for us to see with a resilient consumer, but we continue to wait. What's greedflation? Let me walk you through this quickly. Headline inflation and core inflation are moderating with prices in both food and energy dropping. Further, rent growth, which makes up about 40% of headline inflation, is also slowing, and you can see that in the lower left. Even the Fed-watched core service inflation without housing is transitioning from price increases to price stability. That's great news for the U.S. consumer. Now contrast that with producer price inflation, or just what it costs to produce things. Those prices are on a rapid decline, faster than what consumers pay to buy things. I mean, it's simple math. If it's costing less to produce things, but the consumer is paying the same, corporate America is going to profit. It's pretty hard for corporate America to pass along cost savings, hence you get greedflation. Let's continue this thread as we look at U.S. earnings. Now you can see corporate profits rebounding due to better profit margins. In fact, you can see a very robust rebound in corporate earnings per share in 2024, expecting 12.3% earnings per share growth. As investors discount the future much earlier than reality, perhaps that's the driver of the recent rally, and that might just continue considering we're trading around historic forward PE valuations. The other secret sauce beyond greedflation are stock buybacks. Record buybacks in 2022 will translate into better earnings per share in late 2023 and 2024. There is one forward-looking fly in the ointment for the current rally. Banking and credit look to be on the precipice of a contraction. A recent survey of loan officers suggests steep increases in credit tightening. Further, and not really surprising, loan delinquencies in both office and retail are on the rise. Now you combine this with the recent lifting of the debt ceiling and the flood of issuance of higher yielding treasury bonds by the US government, and there could be a problem lurking. The problem is a flood of capital out of the traditional banking system from bank deposits into money markets that could leave banks, especially small and mid-sized banks, starved for capital. And those are the banks that really fuel commercial lending that's probably at the very core of our economy. Let's keep connecting the dots. The Fed recently signaled some strong language around further rate increases while they paused lifting rates at the last meeting. They're guiding towards 50 basis points higher rates in the coming quarter. Now, with inflation moderating simultaneous to a pause, it's getting very hard to trust the Fed. And in fact, that's why I believe you're seeing some disparity between the Fed's projected rate increases and investor expectations. You can see that in the lower left. That is going to continue to create more market volatility in the coming quarter as these expectations between the Fed and investors merge. The Fed has to deal with moderating inflation, but also a large amount of losses and tightening credit conditions at banks. Perhaps the pause will last a little longer than everybody's expecting. The markets have historically liked a pause with an average return of nearly 18% 1 year post pauses. Let's take a quick look at developed markets. The earnings growth picture is a little counter-cyclical to the US. Developed markets are having a little stronger earnings season the first half of this year, But then next year, it looks to be very anemic with about 4.5% earnings per share growth. Now, again, investors tend to discount the future, and perhaps that's going to lead to a soft second half in market performance. Even though valuations in developed markets are 30% less than the US. One reason is the spate of rate increases across the European Union and expectations for very soft GDP growth throughout 2023, moving into 2024. We continue to remain neutral on developed markets. Moving on to emerging markets like India, China, and Brazil, earnings collectively been in decline. However, expectations for 2024 look very strong, with 18% earnings per share growth compared to a decline of 2.8% in 2023. Now, overlay this with a 36% discount on valuations to the US, and we should see better performance, especially when economic growth in these economies is 3 times that of developed markets. We continue to overweight emerging markets, although those overweights have been challenging in the past year. China in specific has been a tale of hope and disappointment. 81% of economists expect GDP growth above the government's forecast of 5%. The reopening of China post-COVID was a hopeful time that led to an 8% rally in their stock market, only to find the economy sputtering a little in May. Consumer confidence has bounced off the lows, but it's not reflecting a revenge consumer like the US had. Perhaps that's because the Chinese consumer didn't receive the same stimulus US consumers benefited from. Now, one key early indicator is secondhand homes or homes that were sold in the aftermarket. As those trade at higher values, consumer confidence improves, and that should help overall consumption. However, China will need to stimulate direct to the consumer beyond the recent interest rate cuts and tax breaks. More to come with that stimulus this quarter, and that may be the make or break time for China's economy. Fixed income investing, which over the last 10 years has been a sleeper as far as management's been concerned. However, the current environment has required hands-on management. Swapping out durations and tilting towards the short end of the yield curve has been positive. Even if we bought short duration last year, there's an opportunity to swap again. With 3-month yields at 5.3% at the time of this recording, compared to 3.7%, another round of active management's probably in the future. Realizing swapping out will entail some reinvestment risk. You might think you can buy lots of short end duration to meet your needs, but will face some reinvestment risk later. That's what we tried to emphasize in the upper right-hand corner. Let's see how money market demand will impact yields. We suspect shorter duration will remain a little higher for a little longer as money markets will continue to absorb treasury issuance by the US government, and that will continue to be a great place to park cash. So our views and recommendations are fairly straightforward. Obviously, we expect the Fed to do something between continue to pause and raise rates to 5.5% in the third quarter. Our expectation is that with bank credit constraints and the extraordinary issuance of treasuries, we don't think the Fed's going to raise much more than maybe one more time. Combine that with moderate inflation, and we might even see the Fed pause longer. The consumer is still resilient. Strong jobs and wage growth will provide a positive backdrop for corporate earnings. We continue to stay neutral. Europe, they're experiencing some inflationary pressures, and we'll fight that with higher rates, and that should put some pressure on bank stability and equity prices. As we've said, China's recovery, which is important to the world because it's the second largest economy, is on shaky ground, and they will need to do things like direct to consumer stimulus and continue to support the property market. We reaffirm the fact that you should always be reviewing your investment strategy, making sure you have strategic liquidity to cover spending needs and to provide opportunities for dollar cost averaging, especially as money markets are now paying 5%. We think we should slightly increase our weightings in developed markets a little closer to target, but again, we remain neutral on developed markets. We like maintaining an overweight in emerging markets and China as they continue to represent reasonable earnings growth to valuation prospects. We will continue to swap out last year's purchase of short duration treasuries for this year's version of short duration treasury, which we hope we can increase yield without taking any loss to principal. As you scan our mean reversion dashboard, realize we're comparing valuations today to a 20-year average, and that suggests mid-cap value, small-cap growth look fairly promising. Brazil and China look fairly promising. Opportunities in energy and real estate look fairly promising as long as we have a reversion back to the mean. Thank you again for taking a look at our Q3 2023 look ahead. If you have any questions, please reach out to your advisor or you can reach me at the email link below.